On the left, we have our traditional business, and on the right, we have our subscription business. So in our traditional business, we create an invoice, and that invoice will create a credit to a revenue account. So in QuickBooks, that's called an income account. Technically, it's a revenue account, or you can call it an income account. It doesn't matter. It shows up on your income statement. It's revenue. It is your sales, basically, right? So we're going to put a positive number in there. We sell a widget for $100. We're going to show $100 of revenue on our income statement. At the same time, since we're issuing an invoice, we're going to debit our accounts receivable. This is an asset account on your balance sheet. This is a claim to money owed to you by the customer. So you put $100 into sales and you put $100 into accounts receivable. Now in a subscription business, it's very different. When you generate your invoice, we put a credit to deferred revenue, which is a liability account, and it's a balance sheet account. So rather than putting the $100 in sales, or revenue, we put the $100 into deferred revenue, which is a liability account on your balance sheet. We also debit accounts receivable. In other words, we add the $100 to our AR. That's an asset. Again, it's an obligation by your client to pay you that $100 in the future. Now, what's interesting, if you look at this very quickly, is we're doing a credit and a debit to the balance sheet on the subscription side. On the traditional business side, we're doing a credit to the income statement and a debit to the balance sheet. All right. So how do we get revenue onto our income statement in a subscription business? We will periodically debit our deferred revenue account or accounts, and we'll credit our income accounts or our revenue accounts. So when the invoice is issued, everything goes on the balance sheet. And then we draw down our deferred revenue. As we earn our revenue over the subscription period, we draw down the deferred revenue and we put it into sales/revenue/income accounts. Okay, let's take a look at that with some QuickBooks screenshots. So the bookkeeping for a traditional product, you set up your items. So in QuickBooks Desktop, they're called items. QuickBooks Online, they're called products. But in both, you have a name. In this case, I called my product, my item, just product. I could have called it widget or something. It doesn't matter. And I associated it with an account. The default mechanism or default behavior for QuickBooks is to put your products in income accounts. So this is a default name, sales income, that comes with QuickBooks. And when you generate your invoice over here, you pick that product or that item. In this case, we called it product, quantity 1, widget, and it's $3,000 rate, and the total amount of the invoice is $3,000. So what happens on our income statement, or what we also call our P&L, income statement and P&L being the same thing, what happens there and what happens on our balance sheet? Well, per the slide a couple of slides ago, we will record $3,000 into a revenue account, in this case called sales income, and we will record a $3,000 accounts receivable here on our balance sheet. So we have $3,000 as an asset in our balance sheet, which is a claim to money owed to us through the invoicing, and we record $3,000 of revenue in January, nothing in March, nothing in February, etc. Now, over here, you'll note, I'm doing this for a quarter, by the way. It's a one-year subscription example, but I'm doing it for a quarter to keep the amount of content on the screens down. But you'll see here that in my example, the accounts receivable, $3,000, remains open through the first quarter. The key concept, again, is payment doesn't really make any difference when they pay and how they pay, and quite honestly, even if they pay, assuming there's a high degree of probability of collectability, it doesn't really matter if they pay, right? Really, if they pay, the $3,000 comes out of accounts receivables and hits another asset, which is cash. So once they pay, the $3,000 comes out of AR and goes into cash, but it remains on the top side of your balance sheet. You're just swapping out one asset, which is a claim to money, for another asset, which is actually the money. Now, in a subscription setup, you set up an item. I'll call it subscription. This would be your product name or your solution name. And over here under account, I've selected an account named deferred revenue. Now, deferred revenue is set up as an other liability account in QuickBooks. Again, it's a balance sheet account. My invoice really nothing changes on my invoicing side. I pick a product, in this case subscription, I put in a description, a rate, and an amount. And this time I used $1,200 to keep it slightly different. So my invoice looks the same, but my setup is different. So what happens to my income statement, P&L, and my balance sheet? Well, because we're crediting and debiting on the balance sheet and not on the income statement, there is no entry here. We have zero. In fact, this is an income statement with no records whatsoever. So it's 0, 0, 0. I've recorded no revenue, no sales. What I've done is I've put $1,200 into accounts receivable, and I put $1,200 into deferred revenue. So I have a deferred revenue of $1,200 here. Now, if I don't do anything else, it'll stay like this in perpetuity. I may swap out my $1,200 receivables for $1,200 cash, which might be above here, and this will go to zero. But my deferred revenue is going to stay at $1,200 in perpetuity unless we do something. So how is it that we get our deferred revenue, which is what we've invoiced here in excess of the revenue that we can recognize? How do we get the revenue out of here and over here? Well, we do it through journal adjustments. And in SAS Optics, we give you the reports to generate those journal adjustments, and we typically do it by month. Now, important point, we're talking concept here, not details. In my example, I have one client, I have one entry, and I'm using that as an example to keep the numbers really crystal clear. When you do journal entries, we do them at an aggregate level. In SAS Optics, we give you the aggregate journal adjustments to put into QuickBooks, not the customer by customer journal adjustments. We give you the customer by customer deferred revenue and the customer by customer revenue and all of the backup needed, but the entries themselves are done at an aggregate level. In my example, I only have 3 journal entries for my one example. So in January, on January 31st, I'm going to debit deferred revenue, which is I'm going to take away from deferred revenue $101.91, and I'm going to put it into my income account called subscription revenue. I'm going to do the same thing in February and in March. Now I'm going to do a slightly different amount in February because there's 28 days in February. So we're going to generate our revenue schedules and the amount of revenue that we can recognize based on a best practices approach, which is to do it ratably over the term based on the number of days in a period. In this case, we're doing it by month. We have 31 days in January. So we have 31 of 365 times our $1,200. It results in $101.91. 28 days in February, 31 days in March, and those are the journal entries. So what does it look like on our income statement, P&L, and our balance sheet? You can see now nothing's happened to the accounts receivable. I don't really care about the accounts receivable. For purposes of revenue reporting, it doesn't really matter. So whether it's paid now or 3 months or 6 months is a separate issue. If it's uncollectible, there's a whole process for dealing with bad AR, which is distinct from the process that we're using here for revenue recognition. What's important here is the change that goes on between deferred revenue and our income statement subscription revenue. And very simply, what we're doing in January is we're taking our $101 here out of what was $1,200 here. So we were at $1,200, we're taking $101, we're throwing it into the income statement. Come February, we're going to take and draw down another $92.05. So we reduce the balance of our deferred revenue to just over $1,000. And then in March, we take out another 101, and we reduce the balance of our deferred revenue in our balance sheet. So between January, February, and March, we extract a total of $295.88 from our deferred revenue. We do it month by month, and as we draw that down, we record our revenue here, and we reduce the balance of the $1,200 that was initially put in the deferred revenue. Okay, so that is the concept. Now, again, this is a conceptual presentation. So, some clients, this is really the best practices approach for setting up your items and doing it in QuickBooks. Sometimes people don't put their sales into or their items into a deferred revenue account. They just leave them in a sales account, and they do a monthly journal adjustment to take all of the sales out at the end of the month and put them into deferred revenue, and then they go back and add these journal adjustments just as I've done here. There are a couple other ways that you can do it. The one I'm showing you here is by far and away the most popular. The one I just described is the second most popular, and the third and fourth are so infrequent you don't want to be doing one of those, so we're not going to cover them.